Hi everybody, welcome to the Finance This Property That podcast. My name is Dion Fernandez and I am a mortgage planner and finance professional. My goal is to empower financial legacies for generations, and I look to do this by using my over 13 years experience in finance and having special guest speakers like financial planners, accountants, buyer's agents, family lawyers who are experts in their field to provide knowledge and free education. And without further ado, let's get into our episode today. Hey everybody, welcome to this episode of Finance This Property That. This episode is around debunking some myths around commercial finance. I have been seeing quite a few clients over the last few months that are purchasing commercial units or properties, and they all had, these three things that have come up with them, and they didn't know that whether what they could do or how they could do it. So without further ado, let's just get into these myths and let's bust them. Myth number one, you need a huge deposit to get started. Well, the reality is many investors do assume that they need maybe a 30 or 40% deposit for commercial loans, but there are different ways to enter the market with far less capital. Again, it's all dependent on the actual situation. So understanding what the loan to value ratios are in different commercial sectors or commercial property sectors is key. A lot of banks will usually require you to do 70%, meaning that you'd need a 30% deposit plus your costs. Those costs are inclusive of stamp duty, potential GST implications if there's no going concern. But there are some lenders that will go up to 80%, especially if it's the right property, the right sector that they deem that they can go increase their risk profile on. There are special categories like owner-occupied commercial properties that also may qualify for lower deposit requirements because we could potentially use your current residential property or investment property as security. So that lowers the barrier for entry there too. There are different types of lending like low doc and lease doc loans. If you have a strong lease agreement with a good long-term tenant, some lenders consider the lease itself as, helping with that, especially around the deposits needed. You could use cross-collateralization of security, or you can still split them up. But, using the equity in the existing residential or another commercial property that you want, which reduces the, the cash that you have to outlay. And then you've also got private lending and non-bank loans, that options that, obviously give you a few flexible deposit terms, but also some of them may only do a 10 or 20% deposit. But look, the key takeaway from that is a huge deposit isn't always necessary. When I mean deposit, I mean like you need to have all this cash with the right finance strategy and getting the right lending solution that would suit your requirements and objectives. We can find a home for you with not that much deposit. So let's move on to myth number two. Commercial properties or in commercial investments are only for big players. Well, the reality is, guys, commercial property is no longer reserved for the high net worth individuals or large corporations. Everyday investors can enter the market with the right strategy. So there are sort of entry-level commercial properties that you could buy. You can start small. So things like a tenanted office, a warehouse, retail shops, instead of major commercial buildings. And then you can build your portfolio up. There are some clients that are purchasing smaller properties in regional areas or high demand suburban locations that can offer great yields without the $1 million price tag, right? It's all about understanding what you're currently trying to achieve and what you can achieve with your current deposit, equity, borrowing capacity as well. Also, as a small investor, you can actually leverage different types of finance options. You can look at going into partnership to invest in a commercial property, as long as you structure the debt or structure your entities correctly. One that I'm actually seeing more and more of right now is I do a lot. I have a lot of self-employed clients, right? Now, typically self-employed clients don't tend to pay themselves a lot of super, but the ones that do, and they have a lot of contributions that they can make back to their superannuation fund. You can actually purchase a commercial property within your self-managed super fund if you've got one, right? Now, if you're let's say you are a concreting business, right? You need a shed to store all your equipment, your trucks, etc. Well, you can purchase potentially your commercial property under your SMSF and run your business out of that property. And this is the only time you can actually use the SMSF for yourself. You can't buy an owner-occupied property, a residential owner-occupied property, and live in it under your SMSF. That's against the rules, but you can purchase a commercial property under your SMSF and run your business out of it, because the business then leases that property out of the SMSF. And then you're also lowering your personal capital investment because you're using the deposit in the SMSF or the cash deposit in your SMSF to fund that purchase. So all in all, the key takeaway is you don't need millions of dollars to start investing in commercial real estate. You just need smarter financing and structured deals to make it accessible, and have a conversation very early. So that gets me to myth number 3. So we've talked about how to get into that. Now, my myth number 3, and this is what my clients are telling me when we're talking, is getting approved for a commercial loan is impossible. All right. Reality is, guys, while commercial lending is different from residential lending, it is far from impossible. The key is understanding how the different lenders assess risk. Okay. So what does that mean? Well, commercial loan assessments differ from residential loans, right? The lenders focus on both your personal income plus the property's ability to generate revenue. So you've got 2 different ways of doing it. If you're buying it as an investment, the strength of the lease agreement, the tenant history, the industry type will all play a major part in the loan approval, right? How do you improve your odds on getting a commercial loan approved? Well, let's firstly prepare a strong finance package. So before I even send any approval up, I look at the profit and loss statement, your lease agreements that you have, showing that evidence of long-term tenancy. Normally tenants with 5+ years lease agreements are better because it's going to be tenanted for a longer period of time. Choosing the right lender. There are some lenders that specialize in certain industries like, medical, industrial, retail finance sectors, things like that as well. And obviously then working with someone that understands those different lenders and what they can tailor to your needs. The other thing is improve your credit worthiness. While commercial loans rely heavily on the asset performance, a clean business and personal credit history will always trump what you can afford and your deposits, because the lenders want to know, as part of the 5 C's of credit, that you're credit worthy. Your character. Have you been paying your current loans on time? How many approval finance applications are you making of the sorts as well? So that's really key, and they look at that before everything else. So the key takeaway around that is getting approved is about how you present the right set of financials to the lender and structuring the loan properly, and the approvals are within reach. So all in all, guys, my biggest thing is, if you are looking for a commercial property, come chat to me early. Don't come chat to me you can still chat to me if you signed a contract, but it's easier if you come and chat to me early. We can get the right strategy in play, ask the right questions, understand what your requirements and objectives are, put you onto the right team, accountants, solicitors, that'll help you structure your entities correctly, read through the contracts, get you onto good property managers, maybe buyer's agents as well to help you find the right property, just to help you understand, well, is this the right thing for you? Again, my methodology, go slow to go fast. Let's get it right. Get it right the first time and we get a smooth approval process. I just recently had a client where we had to do a full refinance of their owner-occupied residential property and their commercial property. We did the same methodology, go slow to go fast, understood their financials. From submission to settlement, we did that in 9 days, 9 business days. So it just goes to show that it can be done. It's not for everyone, but the barrier to entry is not as scary as what you think. Thanks for listening today. Just to let you know that this advice is very general in nature, doesn't take into consideration your current financial situation. If you want to know more, come and have a chat to me. Jump on Emerge Finance's website, jump on Instagram at Dion Finance Specialist, jump on LinkedIn, send me a message. Happy to have a chat. And as always, see you all on the next episode.